Is Cisco the stock you need to add to your portfolio now? The stock has been compounding investors' gains since the IPO'd back in 1990. Add on the dividends and the share buybacks, and your portfolio would have been on fire. However, the stock has recently dropped about 35% since January. So you have to ask ourselves, are the glory days over? Is Cisco still a great business to own? Or will the stock begin to decline from these levels? Keep watching to find out as we'll be talking about that and more in today's episode. How's it going? Welcome to Everything Investing. I hope you're having a great day. But with that being said, today we're going to take a look at Cisco's Q3 2022 earnings results, where we'll take a deep analysis into the financials. We're also going to take a look at the technical setups to see what is actually going on here with Cisco. And as you can see, we are down 35%, nearly 36% since January. And we're at some key levels right now. And then finally, we'll conclude with a valuation of this business to see whether or not this is something we as retail investors should be adding to our portfolios or not. And if you enjoy the analysis and the value investing perspective, please like and consider subscribing for more of this content. And guess what, guys? In today's video, we're actually going to try something new. We're going to see if we can analyze this business in under 5 minutes. So let's start the clock. All right, so jumping into our technical analysis here, again, if we zoom out, we're actually going to see something very interesting. If we scroll back here, we had all-time highs back in 2000s, and this was due to that Y2K hype, whatnot. We had a severe crash, and then we rebounded. Then what happened? We kind of just consolidated for a little bit, but we steadily gained a foothold and continued higher and higher and higher. Now we're up to $63 a share, but now due to the current economic crisis and a few not so great earnings releases, we're actually back down to lows of $41 a share, if that's where we actually are at post market right now. And if we're looking for support and resistance to hold up here, we should see this level, $41 or $40 per share, hold up as it has in the past and sent the stock higher. If it does not, guys, we should be looking at this stock down into lows of $35 into $30 per share. And make sure you stick around till the end to find out at what price point we'd be looking to pick up shares of Cisco for. Okay, now into the earnings highlights. They came in with revenue for this quarter of $12.84 billion. This missed by about $500 million. Earnings per share came in at 87 cents, which beat estimates by 1 cent. So effectively, they came in exactly where analysts expected, which is a good sign for investors. And in terms of their outlook, they expect revenue to tick up slightly higher, and that their net income figure should actually remain about flat on a year-over-year perspective. Now let's jump into the financials here, guys. What do we see? We already talked about their 3 months figure here, so let's look at the 9 months, right? So we came in with $38.4 billion worth of total revenue, which is higher than last year, which is good. Then we have total cost of sales on these revenues of $14 billion, which actually is not that bad. It's about 50%. And then we need to add back in our operating expenses, which were actually decreasing in some areas year over year. And this led to $13.7 billion worth of total operating expenses, which was down from last year, $14.2 billion. That's actually a good sign, especially when the business is growing. As we can see right here, their net income actually was higher as well, as they came in with about $9 billion so far for the first 9 months of the year. So we're seeing some positive signs from Cisco, despite them being quite an old and mature business. And if this trend continues for the remainder of the year, they came in so far for the first 9 months with $2.15 in earnings per share. Add on another 75 cents approximately, we can estimate that they're going to come in with about $3 in earnings per share. So keep that in mind, as we'll be using that for our calculation at the end of this video in just a second. In terms of the balance sheet, we see that they have about $7 billion of cash on $9 billion in debt. So when we look at this graphic here, it actually doesn't look too bad, and their debt is serviceable. So that's a check mark for me. Let's move on to the cash flow figures here. Drag down our net income figure here of about $9 billion for the 9 months in fiscal year 2022. And we add back in our depreciation, amortization. They add back in stock-based comp, etc., our other non-cash costs. And we come down here and we end up with about $9.5 billion worth of cash from operating activities. We deduct our, let's say, $5.5 billion worth of capex, and in my mind, we're left with about $4 billion of free cash flow to reward investors, okay? What do they do with those cash flows? As you can see, they essentially spend all of it on their share repurchases program here, which in February, they mentioned that they're going to be spending $15 billion on share buybacks to reward investors, okay? So they're spending $5 billion of it there. And because they have cash and debt on the sidelines, they can use that to pay out the dividend and such, and that's exactly what they did. They issued some debt, paid off some debt, and then also paid for the dividends of about $4.6 billion. Typically, this is not something I love to see from a business. What I would want to see is that the business can produce enough free cash flow to pay out the dividend, repurchase the shares, etc. and not have to take on debt. But in Cisco's case, the debt has not become an issue as of yet, and so that's why it is okay for me as for right now. But once the debt starts to pile on, that's when it's going to become a problem. Now let's look at the summary tab here and look at some of the key financial metrics here that might help you with your investing decision. Okay, we have gross margin of 62%. That's very high and very strong as well. Operating margin, let's say 26.5%. That is not bad at all. We have return on invested capital, which is about 18%, which is very, very strong. And that means you're actually looking at a great return on your investment, because typically an investor's returns will correlate with this figure here. Now, in terms of their free cash flow here, we can see they have a decent amount of operating free cash flow coming in on an annual basis. They only spend a small portion of that on their capex, and the rest is for free cash flow, which they use to reward shareholders. So that's a positive. Then we have a dividend yield of about 3.6%, which is actually pretty strong. And then they have the share repurchase plan, which calculates to about a 7% return on your shares. So if you just add in the dividend yield and the share repurchase plan, which is going to give you 7%, you're already at about a 10% return on your investment. That being said, that doesn't mean you turn off this video and go purchase shares of Cisco. You need to take into consideration that they are an older business, which means we need to look, do they have longevity, or are these the last few years before the stock capitulates? These are all things you need to take into consideration. But with that being said, guys, let's jump into our calculator here and find out at what price we'd actually be looking to purchase shares of Cisco for. All right, so let's assume Cisco actually can produce about $3 in EPS by the end of the year. We expect a 10% return. They do pay a dividend. If they can grow at 8% for the first 5 years and then 5% for the subsequent 5 years on a 20 PE, this stock should actually be valued at $71 per share. Guys, if I go back to the stock chart here, they're actually valued right now at $40 per share. In our normal case, that would result in about a greater than 60% upside for Cisco. That being said, when we come back to our calculator here, that does mean they have to be able to grow at 8% year over year over year. That doesn't seem so likely. So let's actually decrease that to about 5%. And let's say they can grow about 5% for the next 10 years. Okay. Then it changes it to 63, some nice upside still. If they can grow at, let's put that 8% and then let's drop that down 5%. Yeah. Again, $83 per share in the best case scenario. And in the worst case scenario, and this is actually the number that we're actually going to be looking for as our margin of safety investment. Let's say they can only grow at 2% for the next 5 years. And after that, they can only grow at 2%. This is being very conservative. $43 per share is the price that we should actually be picking up shares for a 10% return on our investment. This calculator does not take into the consideration that they are also repurchasing shares at an extremely high rate currently. So that's an added bonus on top of this. So assuming Cisco only grows at 2% for the next 10 years, they only need to grow at 2% year over year. Guys, $43 per share is a great time to pick up shares of Cisco, as it's been a compounder. Even if we drop that down, let's say to 0%, and they're not able to grow for the next 5 years, and actually, let's say they can't even grow for the next 10 years, they're only a few dollars off, $37 per share. With that being said, this is the analysis for Cisco's Q3 2022 results. If you made it this far in the video, please like and consider subscribing for more of this content. And with that, I'll see you on the next one.